Welcome to Private Capital Call, a podcast with leaders in asset management, investing, and capital markets. I'm Randy Schwimmer. This week, we talk with Van Hesser, Chief Strategist at KBRA. He has his own podcast, Three Things in Credit, which I highly recommend. Van, welcome to Private Capital Call.
Thank you, Randy. Delighted to be here.
So one of the topics that you covered recently was sort of landings, as in soft landings, hard landings, no landings. I'm actually calling this one Knots Landing for fans of that show. It's so hard to read because when you look at inflation and growth, there's been very few straight lines since this whole thing began, back in March, I guess, of last year. What do you see where we are right now and where we're headed?
Yeah, it's a great question, Randy, and I love the Knots Landing reference. For those of us of a certain vintage, I get that. We really have been in the soft landing camp for quite some time, and I think we still remain there, despite really breathtaking, at times, sentiment shifts out there in the market. So, we start with the Fed, right? If the Fed has to tame inflation, and we've never second-guessed their conviction to doing that. The market has been all over the place, as you know, in terms of how they have been interpreting what the Fed is doing. But from our perspective, they are absolutely committed, right, to tame inflation entirely. And so that, to me, means the fastest hiking cycle that we've seen in 40 years. It means a commitment to continue to run down the balance sheet. The Fed is not credit's friend at this point in this cycle, right? It needs to cool demand. And rest assured, what we've seen in the tightening of monetary policy, what's going on with the banks, markets are being more restrictive. All of that forms a pretty significant headwind that is going to slow the growth in the economy. Do we think it tips over into recession? We don't, right? We think that the strong starting point that consumers and businesses were in coming into this gives them a fair amount of power to get through this. But rest assured, we are going to, growth is going to slow. That's our view of 2024.
Yeah, and it seems like economists have been surprised by the strength of the economy, but they still predict, even though the economy is pretty strong, they still predict signs of a slowdown. What are you seeing that is pointing to that slowdown?
Yeah, well, again, if we really focus on the consumer, we should, right? 70% of the economy. I think we all underestimated the power of the excess savings, the leftover stimulus money that flowed really all the way through 2023. And then there's a behavioral aspect to this that I find fascinating. Whereas businesses, I think, can read those tea leaves, and this has been clearly the most well-telegraphed downturn in the history of downturns. And so businesses were way out in front of this, doing things that they should do at this point in the cycle or at that point in the cycle. That is, cut costs, try and hunker down, and postpone CapEx, do the kinds of things to be able to ride through a downturn. Consumers, on the other hand, are a bit delusional, right? They get used to a spending level, a lifestyle. And that, by the way, changed materially for a lot of folks through the course of the pandemic. And so they tend to be slower to dial that back. And so I think in a perverse sort of way, that powered the economy in 2023. But it also makes us a bit cautious as we look ahead. That excess savings is running down. We are clearly seeing it in the borrowing data, consumer borrowing, that they are tapping out credit cards. So all of this is going to, we think, put a damper on consumer spending. And of course, that's going to flow through the economy.
One of the other things that was a big surprise for me was in March when three banks failed, and there was a lot of talk about the collapse of the banking system, and analysts saying, there's more to come. What happened to that collapse?
Well, I think if we look back with 2020 hindsight, and even at the time, those were three highly idiosyncratic stories, right? So three good-sized banks out of 4,700 failed. And by the way, they failed in the midst of the highest or the fastest hiking cycle in 40 years, right? So as a long-term observer of banks and how they play out through the cycle, that honestly was not that bad of an outcome. And so I think once markets got comfortable that those were highly idiosyncratic stories, that story of financial instability got pushed, back to the back burner where it probably belongs, right? Now, when we look at, the interesting part of all of that is the mark left on the industry is that banks now have to be very strategic and thoughtful about how they grow because they've got to adjust their funding structures, which, are coming under a bit more scrutiny for a variety of reasons, competitive reasons, et cetera. They've got to figure all of that out. And I think as a result, we now see it in the, Fed senior loan officer opinion survey data. Banks have tightened credit across the board to consumers, to commercial and industrial borrowers, to commercial real estate at levels that we typically see in a shock, right? So if you sort of partner that then with what the Fed is doing, again, that forms a pretty significant headwind. But the important takeaway here is, and this is really, really important, because it can turn a downturn into a crisis if there's financial instability. In our view, there is not financial instability here. The banks collectively, in the aggregate, are in pretty good shape to ride out this downturn.
And you mentioned they're tightening credit. So there's a natural tightening because of high interest rates. So in the mortgage market, C&I loans and, people trying to get small business loans. But on top of it, you're saying they're actually being restrictive in terms of their extensions of credit.
For sure. Again, they've got to get their own house in order, figure out how to message to the market that their business models still work. We are big believers that there are significant, business model issues with the community and mid-sized banks. That's really, really misplaced. But to acknowledge, or it's worth acknowledging that they have some shifts to make. And so, they're not going to be there to fund growth into this part of this credit cycle as they would when in more normal times.
So let's talk about systemic risk, in particular with private capital. It seems like after that March episode, for some reason, analysts looked at the banks and the collapse of those three banks and then said, well, there must be problems in the private credit sector, which didn't really, I think, make a lot of sense to me because the banking system is focused on deposits, collecting deposits, which the private credit market doesn't. The issue that those banks ran into was mismatched funding, which most private capital providers have long-term assets, long-term liabilities. So what's going on with this question of systemic risk, which, by the way, I believe some regulators have come out and said, they don't believe that that's necessarily true. Why is there even this view that there is heightened risk as a result of private capital? That's just confusing to me. Maybe you could clarify, help me figure that out.
Sure. I think in some respects, it's a reflection of what's new. So, very interestingly, one of the most effective things that bank regulators did post the GFC was to de-risk the banking system, right? It was talked about for decades to try and get banks to narrow their focus a bit. And so through a variety of regulatory actions, again, the regulators drove a lot of riskier lending out of the banking system. And we certainly have seen a lot of capital come into the private capital markets over the last 10 to 12 years or so. But I think the newness of all of that and that rush of money into this space gives, conservative-minded folk a bit of pause as they try and figure out, is this a good thing or a bad thing? From our perspective, this is absolutely a positive evolutionary step in the financial system in that you've taken a lot of riskier activity, lending, investing out of a dozen or so global banks who, by the way, cede control of their decision-making to regulators in times of stress. You've pushed that now and you've diffused that risk across the globe out to 1,000 institutional investors. That, to me, is a much better shock absorber in times of stress. The other thing that we really like is that you get out of short-funded banks into a bunch of illiquid or long-dated assets, and you move that into a much more prudent funding framework where you've got long-term locked up money funding illiquid assets. That, to me, again, is a real improvement that's going to dampen the volatility of the credit cycle. That, to me, is very much of a positive. But again, back to your question, Randy, it's a good one. As much as we'd like to believe that this story, this narrative is going to be clear to all market participants until it's really tested, I think people are going to need to see this through a cycle to get really comfortable with it. But again, from our perspective, it doesn't mean that there's not riskier lending out there. It's just that it's in a much better place and funded in a much better way.
So we talked about banks versus the private credit market. Let's talk about public credit in the form of the BSL market, the broadly syndicated market, for example, and the bond market. There seems to be and I heard one individual at a conference I attended recently call it mistaken pattern recognition for private credit, where analysts look at the public markets, they look at the liquid market, the BSL market, and they look at things that have either gone on during the GFC with the liquid loan market or going on now and extending that to private credit. So things that they're seeing in public credit, so for example, defaults or prices going down on loans or whatever is happening, and saying, well, by extension, that's going to happen in private credit, when it's a very different model because private credit doesn't trade. It's a hold only. It's a buy and hold model. It's, as we like to say at Churchill, it's a storage model, not a moving model. Mm-hmm. And so, it seems like what we're trying to do with these podcasts and with the Lead Left is to educate people as to what the differences are, and particularly with defaults, right? And you had a great podcast, you and your default analyst, Eric Rosenthal. Talk about, what the difference is between the way that the public loan managers deal with these things and how private credit does.
Yeah. So, the wisdom of crowds can cut both ways. And I've witnessed this all the way up over my career into the investment grade market. Plenty of times you get a whiff of an issue, China slowing, the Fed hiking rates, anything that give people or dealer desks a chance to sort of back away. And by the way, those dealer desks have gotten a lot smaller relative to the size of the markets they're supporting over the last 10 or 15 years. And so the public markets can be quite volatile around headlines. Whereas just intuitively, one of the things that to me is something that we acknowledge is that, again, private credit isn't going to be affected by every zig and zag in the market, every headline that comes across the tape, right? Your long-term lenders, you're in there ready, willing, and able to work with borrowers to, ride out, their business over a long period of time. That is fundamentally different than how the public market, in all of its quote-unquote wisdom, is going to treat, say, the BSL market. So again, it's really apples and oranges from our perspective.
Yeah.
We acknowledge, we always want to be aware of what markets are telling us, but when we look at public markets and the volatility around those, you got to be careful about taking that signal or your interpretation and applying it blindly into the private markets. They're really, really different.
And yet, when these analysts look at, for example, default rates right now, which are pretty low, I mean, I think you and Eric talked about kind of a 3.5% to 4% default rate currently for BSL and bonds,
right? Probably
in that range, sounds like, for 2024. And so when you have certain research agencies calling for a 5% default rate for private credit, it doesn't seem to make sense. In particular, given even the current trend, Proskauer has a great index that they follow, and they've been reporting every quarter the actual decrease of defaults in private credit quarter after quarter, not an increase. How do you view that discrepancy?
Yeah, well, again, in some respects, it does go back to the cycle, right? So I think there's this, and if I think back to a commonly held view 12 to 18 months ago when there was a broad consensus that we were heading into recession and recessions aren't good. Recessions have 10% default rates in leveraged finance. And why is this going to be different? Well, we learned in 2023 why a lot of this is different. And again, we had that suspicion back in the tough times of the back half of 2022. Yeah, we are slowing. The Fed is not going to be our friend through this, but the strong starting point of consumers and businesses heading into this probably gave us a sense that this might not be a traditional recession. We also think about how the default market or default environment has played out over the last call it 6, 7, 8 years. We had the energy washout back in 2015, 16. We had the retail apocalypse happen. We had COVID, right? So we had, in some ways, kind of some rolling defaults, mini default cycles, if you will. So what's left at this point is reasonably battle tested. So that also points us, I think, toward a significantly lower default rate than what we've witnessed in the past. And again, I remind you that, we're not going in our view. This is not going to be typical recession if we even get there. Our view is that we won't get there. We might get toward stall speed for a couple of quarters over the next 2 to 3 quarters, and we might come out of this with sub-trend growth. But that's very different than going into a recession where you might have some financial instability and you've got a lot of uncertainty. The other interesting thing I think about this cycle, we know what the problem is, inflation, and we know how to cure it. It just takes time. So I think the visibility around that has been relatively clear, all things considered. It's another way to suggest that this downturn is going to be something that's going to prove to be more manageable than what we've seen in the past.
I think you and Eric also pointed out there's a big difference between having a default in a liquid loan environment and one in the private credit environment where you have financial tests, you have lenders who, as you pointed out, all kind of work together. They have an alignment with the owner, typically a private equity sponsor who doesn't want to lose money, and they're going to do whatever they can to keep this going. And you also have there's a big difference in the liquid market where you have lenders who come in at various stages of how that loan gets priced at a discount, and some of whom are really just looking to get out and make a little bit of money and not necessarily get out at par. And so it creates this dynamic which makes it very difficult to sustain 100%, value through, to par through those situations. Last question, Van, for you, and I think you've outlined sort of the economy, inflation and rates and so forth. What, for the next 12 months, should private capital investors be focused on? Assuming that this plays out, it's a soft landing, we don't have a hard landing, it's not, it might bump along at, I think you used the term at some point, stall speed, which I like. What should investors be thinking about and aware of and watching for?
Yeah, the biggest thing that we're focused on, Randy, as we sort of look ahead, is that we're moving back to normal, right? We haven't been normal in 15 years, right? All post the GFC with massive QE around the world, 0% interest rates engineered by central banks. All of a sudden we're looking at a normal cost of capital, right? So all of a sudden achieving an acceptable rate of return is not going to be as easy as it was. I had one of my guests on my podcast a week or so ago said that, in 0% interest rates, the intelligence of borrowers and lenders goes down. And so we're coming up out of that, right? So we're getting back to normal. You've got to have a business model that can withstand the environment. We'll talk about that in just a moment. And you've got to have an appropriate capital structure. So in terms of your business model, you've got to be able to absorb normal interest rates, not 0% interest rates, but you've got higher interest rates. You've got slower growth probably coming out of this. You've got to be able to withstand technological disruption. One of the things that we think a lot about with every single credit that we look at, what is the vulnerability to technological disruption? Which side is this company, is this business model on with regard to technological disruption? You've got higher costs coming out of this related to all of those ESG things, whether it's the energy transition or security of everything, right? So you've got higher costs sort of to deal with. All of these things, I think, are going to present pretty significant headwinds. And so it's going to be back to normal, which is going to feel, again, very, very different than a lot of what we've gone through in the last 15 years.
Van Hesser, Chief Strategist at KBRA and podcaster of Three Things in Credit. It's terrific. Go get it and listen to it. Van, thanks for joining us on Private Capital Call.
Thanks for having me, Randy.